Welcome to today's live webinar. We'll be getting started here momentarily. We're going to give a chance for the viewers to log in. Okay, great. So thank you again for joining. Today's session, we're going to be going over how to exit a ROBS 401k plan. And I would ask you to please ask questions as we go through the slides. You can ask questions in the chat. If you're watching this video as a recording, we'll be posting chapters in the YouTube description. So if you expand the description, you'll be able to jump right to a specific spot in the video. You can also ask questions if you're watching on a recording in the comments, and we get back to comment questions within the same day or 24 business hours. So please also like and subscribe. So let's get started. So here we've got a roadmap of what we're going to be discussing in today's session. We're going to go over the basics as far as what a ROBS 401k plan is. We're going to talk about some of the top exit scenarios. Then we're going to talk about different exit strategies in more detail. And then, of course, how you can learn more about your situation. So as far as the basics, a ROBS 401k, or what's called a rollover as business startup, is a transaction that's going to allow you to use retirement money to start or buy a business without paying taxes or penalties. In terms of some of the key ROBS requirements, you have to have money that's eligible to be rolled over. So that's going to mean money in a former employer plan or a non-Roth IRA. You can then use the money to start or buy an active business. So that could be like a business that's providing goods or services. You have to operate the business as a corporation that's taxed as a C corporation. And whoever's going to be transferring and rolling over retirement money needs to be able to participate in the plan, because that's the foundation of the transaction, which therefore means they need to be a bona fide employee. And just again, to set the foundation as far as the steps in the process, which helps us understand some of the exit strategies. The first step is incorporating the C corporation. The C corporation then sponsors the 401k plan. You roll your money into the plan. The plan is going to allow you, like our IRS approved plan does, allow you to invest in the stock of the C corporation. And then the C corporation is going to buy the business, start the business. So that's the entity that you're going to be using as your operating company going forward. And the company is going to, again, issue stock back to the 401k in proportion to and in exchange for that investment of 401k funds. So I'll stop and just remind people, if you have questions, don't hesitate to ask as we go through the slides, and we'll address them here during the webinar. So some of the top exit scenarios would be you sell the business. Another exit scenario would be is your business closes. Let's say your business becomes insolvent. And then another scenario would be you still want to own and operate the business, but you don't want to own it. You want to now operate it as an S corporation. Remember, we talked about one of the foundational requirements is that you have to own and operate the business as a C corporation. So if you want to convert to an S, you have to get to a place where you no longer own stock in the company through the 401k. So we'll address that as we go through the slides. And I see we've got a question here, which is really more about our solo 401k. So I would ask you to email us at business@mysolo401k.net, and we can address that question. Thank you so much. So in terms of how to exit a ROBS 401k, let's talk about the scenario where the business is sold, right? So you set up, fund the C corporation initially through that 401k business financing plan. Then let's say you start a business or buy a business, and now you want to sell that business. Typically, in our experience, when our clients are selling their business, they're selling it as an asset sale, because oftentimes the buyers prefer the asset sale, so they don't have to worry about picking up any latent liability that might be associated with the entity. So instead of buying your corporation, they're going to buy the assets underneath your corporation, right? Your inventory, your equipment, your goodwill, etc. So the corporation, in simple terms, sells the assets, and the proceeds of the sale flow to the C corporation. Now, typically, although you could pursue a different business opportunity, if you want to wind down that C corporation, and just get out of business permanently or for some period of time, you would wind down the C corporation, which means that the C corporation would have to pay back any creditors that are owed money, and the remaining proceeds would flow to the stockholders in accordance with the ownership percentages. So under that 401k business financing plan, there's going to be at least two stockholders. There's going to be you personally as an individual, and then through the 401k. And so those initial ownership percentages are going to be based on how much money you invested, the ratio of retirement and non-retirement money. So if you invested 80, 90% of the money through the 401k rollover, you would end up owning 80 or 90% of the stock through the 401k. So when the proceeds are returned to the stockholders, they're going to go back to those owners in accordance with the ownership percentages. So if it was a stock sale, the less common version, then the buyer would just be buying the stock directly from the stockholders. So then the money would just go directly to your 401k and you personally, if those are the two stockholders. And of course, this is a high-level view of winding down a corporation. Anytime you're winding down a corporation, there could be legal, very likely there's going to be legal implications, tax implications. So you're going to have to bring together your team of tax and legal advisors to really guide you through the whole process. But certainly we do support that from a 401k perspective with respect to our clients. Now, once the money is back in the 401k, the plan needs to be wound down because the sponsor of the 401k is being wound down. So that means that in order to properly wind down a 401k, the assets need to be distributed or rolled out of the 401k. So you can roll those assets over to an IRA. If you have a new 401k plan, like say you got a W-2 job somewhere, and they might allow you to roll assets into your new 401k, you could take a taxable distribution of those proceeds. Whatever you decide to do, whether you're doing a rollover or a distribution, that's going to be a reportable event on a 1099-R. And then once all the assets are rolled out of the plan, a final Form 5500 needs to be filed. So because you funded your business via a ROBS 401k, as you're operating your business through the years, you're going to need to be filing a 5500 every year. And we handle that as part of our services. And then when you to properly shut down a 401k, you have to file a final Form 5500 once all the assets have been rolled out. So, and I see we got some good questions here. Thank you so much for asking those questions. So what I gather from your question is how does this work if the business has leverage and there's more money needed? So I'm assuming you're talking about a situation where the business owes a loan to, say, a third party, and the proceeds of the loan is not enough to satisfy the loan, such that there's no money left to go to the stockholders. In that situation, that's going to be more like in a closing of the business or an insolvency situation. So there may not be enough money left over, in other words. So if there's not enough money, so the creditors get paid first and then the stockholders get paid. So if there's no money left to return any funds to the stockholders, then nothing goes back to the 401k and nothing goes back to you personally. So that's similar to the liquidation scenario, which is our next slide. So let's say your business goes out of business. So in that situation, the corporation would typically liquidate its assets, right? Take the proceeds, pay back the creditors. You would wind down the C corporation. If there's any proceeds left after paying back the creditors, that would be similar to the prior slide where it's flowing back to the stockholders in accordance with those ownership percentages. And again, you're going to want to be working with your tax and legal advisors because there certainly could be special considerations, especially if you are in the bankruptcy context. But once the assets, if any, are back in that 401k, it's going to be a similar process of winding down the 401k. So any other assets you already had in your 401k account, let's say you rolled over, $200,000, you invested $100,000 initially in the stock of the business, leaving $100,000 in your 401k, you would still have that $100,000 in your 401k subject to any gains or losses. To properly wind down the 401k, you're still going to have to empty out that 401k account, roll it over to an IRA, say, take a taxable distribution, whatever the case may be, issue a 1099-R, and then file the final Form 5500 to properly wind down the plan. Okay, so thanks for the good questions. So please don't hesitate to ask more questions as we go through this. So let's shift gears and talk about a different scenario, which is the stock buyback. So oftentimes this is used when the intent is to convert the C corporation to an S corporation. So under the rules, your business has to be a C corporation as long as you own stock in the company through the 401k. So the typical way to get the stock out of the 401k, or better said, to get the 401k out of owning part of the company, would be if the company were to buy back the stock from the 401k. And this is where understanding the initial steps to fund the business, where you rolled over money, etc., where that's going to help us understand the buyback. So initially, to recap, you roll over money from your existing retirement account into the 401k, and then you buy stock in the company, right? So the money transfers from the 401k to the corporate account. The corporation issues stock back to the 401k. And I see we got another good question. Thank you so much. So the stock buyback is the reverse. So the company now is taking money from the corporate account, transferring it back to the 401k, but it's not doing it as like a profit distribution. Instead, it's actually buying the stock back. And so it could buy back all the stock. It could buy back some of the stock. It could be a full or partial buyback. For each time it's buying stock back, it needs to buy it back at fair market value at the time of the buyback. So again, the funds flow from the C corporation account to the 401k account. That's going to be decreasing the relative ownership percentage in the 401k, because those outstanding shares, the nominal number of outstanding shares is decreasing. So relatively, your 401k is owning less percentage-wise in the 401k account. So of course, you need to update the corporate records like the stock ledger. Once the company's bought back all of the stock from the 401k, the company could then elect to be taxed as an S corporation. Now that company is still going to be maintaining the 401k. Like in this scenario, you still own and operate the business. You just don't own it if you do that full buyback. If the company does the full buyback, you don't own it through the 401k anymore. Like you might have owned like a relatively small percentage of the company after the initial funding, but after the buyback, now you might own 100% of the company. So you still own this company. You don't own it through your 401k anymore. The company's still in existence. It might be an S corp now. The company still has a 401k plan. Like the plan is not shut down. Under the permanency rules, it wouldn't be appropriate to just shut down the plan immediately following the buyback. So you would be able to, though, invest the money, the proceeds of that buyback, the stock buyback, are now going to be in your 401k account. So typically you're going to have a brokerage account. Like with our process, when you initially fund the business, you first have a brokerage account that you roll your money into. So when the company's buying that stock back, the money is going back to the brokerage account. And now you can invest it however you see fit through that brokerage account. So again, you're going to continue to maintain the 401k. It still needs to be offered to eligible employees. You're still doing the annual 5500 filing, but now you are no longer owning it again through the 401k. So good question. No, it doesn't. The stock buyback can be just to the 401k. It doesn't have to be pro rata. So you don't have to maintain those ownership percentages. As far as the NUA question, that's a great question. That's really beyond the scope of this presentation, because the eligibility, it's a more advanced transactions. And in our experience, the eligibility requirements or the eligibility requirements make it something that, practically speaking, is not typically done. If we have employees participating in the 401k, do they need to be offered opportunity to buy stock in the buyback scenario? So in the buyback scenario, the company is not doing another stock offering. It's buying stock back from the stockholders. So that's not going to be an event that's going to be an offering that would have to be made available to eligible employees. Because remember, it's the reverse of how you funded the business. Good question. So please don't hesitate to ask more questions. We can keep spending more time on these topics. But if not, we'll go ahead and go to the next slide, which is the in-kind stock distribution slide. So here, this again is a scenario where you still own the business, you still operate the business. So it's not like you've sold the business or your business is closed in our first couple of scenarios. So it's more like the buyback, but instead of the company buying out the 401k or buying back that stock from the 401k, the stock is now just transferred. So it's not owned by your 401k, it's now owned by you personally. And you are not allowed to buy the stock from the 401k plan. Like, you cannot send money to your 401k account and then have the stock transferred to you personally. That would be a prohibited transaction. But what you can do is you can take an in-kind stock distribution. So this is like taking cash out of your 401k account, but instead of taking cash out, you're taking an asset out. But just like if you took cash out of your 401k account, you have to pay taxes and penalties if you're under 59 and a half years of age. So again, the stock, per the first bullet there, the stock is transferred from the 401k to the individual. So unlike the buyback, where the corporation needs the money to be able to buy the stock back from the 401k, there's no cash that's actually transferred out of the C corporation. Of course, you would update the stock ledger because now you don't own the stock through the 401k, you own it in your own name. So taxes and penalties based on that fair market value at the time of the in-kind stock distribution. There's going to be a 20% withholding requirement, just like with any taxable distribution. It has to be reported on a 1099-R. The value of that stock would be reported on a 1099-R. And then you'd have to include that in your income for the year of the distribution. If all of the stock is distributed from the 401k, just like in the buyback scenarios, you don't own any of the company through the 401k anymore, the entity could elect to be taxed as an S corporation. And again, you would still continue to maintain the 401k if your business is still operating. You wouldn't shut down the 401k in connection with the in-kind stock distribution. So that actually takes us to the end of the slides there. So please don't hesitate to ask more questions. We do have plenty of time. You can reach us at business@mysolo401k.net, 1-800-489-7571. You can ask comments if you're watching on the video, and like I mentioned, we'll get back to you within 24 business hours. So I thank everyone so much for the participation. Please like this video and please subscribe to our channel so you get notifications of our weekly webinars. I don't see that we have any more questions. So thank you so much for everyone's participation. Take care.